right, good morning, everyone. Let's do a quick sound check. Let me know if you can hear me and if you can see my chart. All right, thank you, Chris. Share my screen here with you. All right, good morning, everyone. Paul, thank you. Fantastic. Okay, good. So hopefully everyone is doing well this morning. Today's May 4th, 2020. Hopefully everyone is safe out there as well. Before we begin, remember that trading is risky. Please don't trade with funds you cannot afford to lose. The disclaimer is typical across all the videos that I have as well as on the website. Just remember that trading is not for everyone. Just be careful when you do trade. We encourage you actually to practice before you start trading live, and that's why we do help you get the NinjaTrader simulator, practice, ask questions. That's very important. Fantastic. Thank you, Sally, Evan, Paul, Chris, Joe, Adrian, everybody here in the room. So what I'm going to do today is go over what to do as we move forward into the future, as we look in the rest of the year, how we can take advantage of possibly the market coming back up and moving higher, which I believe the market is going to go higher, but we need a little bit of proof, a little bit of evidence before we decide to buy the market, and that's on a longer time frame. As a day trader, DayTradeToWin offers a few trading methods and software along with the mentorship. Now, everything that I do is based off of price action. So if you see the market going up, if you see the market going down, that's why we buy or we sell without moving averages, without MACDs, without indicators, without any type of conventional indicator. So you see here I have a 250 tick chart. Typically, I like to look at a 1-minute chart, and under a 1-minute chart, let me just remove here the indicators that I have. We can just focus on the trade scalper. And I also like to add the ATR, the average true range, with a setting of 4, which allows me to understand the type of market that we're trading. If the market is slow, I understand the market is slow and I may not be able to trade this time frame. If the market is too volatile, for example, a 5-minute chart where I have hundreds of videos traded, because the 5-minute chart is a balance of the market being divisible by 5, 10, 15, 30, 60, which is what most traders are looking to trade. So if there's a move about to happen, the 5-minute chart is able to capture it. But if the 5-minute chart is too volatile and it's not tradable, then there's no reason for me to involve that risk. So the ATR, the average true range that you see down here, is based off of the last 4 candles, and it allows me to say, moving forward into the future, the next 4 candles, what can I expect? Sure, Al. Let me know if that's a little bit better. I raised the volume here a little bit for you. There's also a sound, I believe, a sound volume there on your end as well. Thank you, guys. Thank you, Tony. So what we have here is moving forward into the future, the next 4 candles, I can already predict that the market's going to move about 3 to 4 points from where we are right now. Now, this is important because if you have a stop that's too large or too small without realizing what the market can do, then we're maybe having a stop that's unnecessarily risky, where we're risking 5, 10 points unnecessarily. Or maybe the stop is too small. So if I look at having a 1-point stop, I already know that the market could move about 4 points up or down from where we are. So a 1-point stop will never work under these conditions. So what I like to teach is understanding price action, the market conditions, the expectation of the market moving either 1 point, 2 points, 4 points, 5 points, whatever the case may be, and then putting rules which are objective to say I'm going to buy for this reason or I'm going to sell for this reason. And if this doesn't align up, if I'm not willing to risk, for example, 3.5 points on this trade, then I can't trade this specific market or this chart. Maybe I'll go down to a 30-second chart or a 10-second chart. Or in the past, the market's been too slow. So even on a 5-minute chart, we've seen the ATR at 1 or 3 ticks, and that's untradeable. When the market's that slow, it's not worth spending your time on the specific market. So what I recommend, and I tell everybody, is that between 5 points here and 1 point should be your sweet spot to trade. Anything less than 4 ticks on any market, but we're looking at the E-mini S&P, so 1 point. Anything less than 1 point or 4 ticks is too slow. That means that the market within the last 4 candles, whether it be 4 5-minute candles, 4 1-minute candles, is just flip-flopping. Anything above 5 points becomes, or 20 ticks, it's too much of a risk. We have to risk too much to stay in the trade because you see the market doesn't necessarily, or these moves that are occurring, they're not necessarily all up or all down. The market does this, right? So if your stop is smaller than what these candles, the range from high to low, which is what the ATR is indicating, if the if you put your stop too small, you're going to get knocked out unnecessarily on this movement, on this chop up and down. Let me know if anyone has any questions on that. This is some price action basics that I think as a trader you should understand, you should know before jumping into a trade. At least know that the ATR will indicate the distance the market could move. Not necessarily up 4 points or down 4 points, but the distance that these candles, the range from high to low, is going to be making. So if I put here a ruler from here to here, this is 2.75. If I put a ruler from here to here, this is 4.5. From here to here, this is 3.25. So it aligns up with expecting the market to move between 3 and 4 points within the next 4 candles, and that's exactly what the next 4 candles did. They're moving in this range high to low. All right. That's the first thing. The second thing is looking for signals and expecting a target. Everybody wants profit target. I would love to say that we could make 10 or 20 points on each trade, but without having some evidence that the market could move that distance, it's best to again look at the ATR and say what type of distance can the market make. So if I know the market is moving at about 3.5 points or 4 points or 3 points, then my target should be more aligned with the ATR to tell me what the expectation of that distance is going to be. So if I go short, for example, right here, I can expect the market to make 3.5 points. If I go long, I can expect the market to go 3.5 points. We also limit the amount of time that we're in a trade. So if the market is just flip-flopping around and you're in a trade for an hour, there's no reason to continue to stay in that trade. Look for something else. So typically I like to limit the amount of time and the risk that we're in a trade because the longer you hold on to a losing trade or a move that's not doing anything that you're expecting, the more risk you're subjecting yourself to. So I recommend that when you enter a trade, we want to see an immediate result. If not, cut it loose, let it go, look for the next opportunity. So if anyone here has watched the videos that I have on DayTradeToWin.com or on YouTube or all throughout the internet, you know that I like to use a time-based stop, typically 4 candles, 4 bars, whether it be a 5-minute chart or a 1-minute chart. I like to use a catastrophic stop, which is the maximum amount of money you're ever going to risk on any trade. And I like to use either a pivotal stop or a prove it stop. So a pivotal stop is typically when the market makes a pivot and it fails, doesn't go in your favor and breaks that pivot, you should have your stop just below, a tick or two below that pivot. So just giving you a roundabout example here, and this is more for the Atlas line than it is for the trade scalper. But if you went long here as an example, just giving you here a rough example to go long, you see how the market went like this. You could consider this lowest low a pivot, and then I add 2 ticks below that in order to say if the market does come back down and breaks this pivot by a tick or two, I'm out of the trade. It's a pivotal stop. In addition, the time-based stop and catastrophic stop. So I always work with a grouping of stops, whichever happens first, to get out of the trade in case the trade goes wrong. I'm not limiting myself just to a hard price-based stop. So instead of just saying I'm always going to risk 3 points or 2 points on every trade, you say I'm going to enter into this trade. Whichever stop gets hit first, whether it be time, the catastrophic stop, or the prove it stop, or pivotal stop, then I'm out. So you're getting out of the trade at a smaller loss than just the catastrophic stop. And the target here is very simple. The target, you can see that it should be about 3 points. Even if you want to be a little bit more conservative and say 2.5 or 2 3/4, you know that the distance the market could make is this here. Now, obviously, we have to look at news. If you haven't downloaded the news indicator, I offer a free trial on the news indicator. I'll add it here to the chart. The traders who are in mentorship, they get the news indicator as well without any type of ads. Okay, so the news indicator indicates the times and the days, and you can set this up where you want to see international or just the US news, which I like the US news and only the high priority news events. So I'm looking at May 5th and May 7th here in orange. I'm not sure if you can see that there, indicating that there's high priority news events I have to be careful with. And you shouldn't really trade during a high priority report or news event on employment, PPI, the FOMC, manufacturing, because when that report is released, there's typically a jump in the market based on that report. And that's not something I want to be involved with because the market will typically move very fast up or down or be a little chaotic at that time. So during a news event, I recommend, or a news release of a report, just wait 10 minutes until the news is released. Let everyone buy or sell to get out of the way, and then we can continue what we're doing. All right, anybody have any questions here? Wes, Tony, Siwak, Sally, Robin, Rich, Neil, Nigel, I should say, Kerry, Mark, JJ, Joe, Evan, Charlie, Bob, Al. All right, a lot of people in the room. Okay, so as we wait here for a signal to go long and short, I'm going to look at a daily chart here to give you kind of a prediction of what and how we can trade this crazy situation we've seen the last couple of months. What are we going to do with this? So let me just adjust this here a little bit. Okay, so everyone sees this huge drop that the market made here in February. Now, we came to this low here, and the market is now starting to go up. The question is now going to be, where do you buy or where do we sell? Or how do we approach this? Because there is an opportunity here that I feel to the long side, and we just have to make sure that we do this right. So here is my recommendation on the type of movement I believe the market is going to do. I think the market by the end of the year is going to come very close to the highs that we were at back in February, January. So I believe that 3,400 is the move. Now we just can't buy and hold because it's impossible for us to have 200, 300 points of a stop on the market on the S&P. It's just we don't have that kind of money to withstand ups and downs. So what I want to do instead is I want to look at where the market makes a determining factor where we start to break. As you can see, I have this tool here that gives me the midpoint. And so I want to make sure that at this point here, 2782, the midpoint, is where the market stays above for me to look for long opportunities. And we could very well stay like this for 2 months within an area where it just stays here hovering on the midpoint. This has happened a lot. If you look at history, you're going to see that every time the market drops, see if I can show you another example. Add a few more days here, where the market drops this hard and this fast. Before it goes up, it stays at the midpoint, the 50% marker, for a little bit and then continues up. So let me add here 2,000 days. So what I want to do is I want to look at, for example, from here to here, you see the market stayed in this midpoint for a little bit before it went up. Or the same thing is true if I look at from here to here. The market went up and then stayed above the midpoint in a little bit of a range before going higher. And the same thing is true here. Not as pronounced as we've seen it. So, these examples are much smaller, but the idea is the same. Once the market makes this a bit of a drop, once it hits the midpoint, I expect it to go higher, but it may stay within this middle area here, flip-flopping for a little bit before it goes up, before it goes back up to test the highs. But each of these examples, the market did in fact go and test the highs and move higher. So based off of these examples, the same thing is true here. Where the market made a big drop, came back up to the midpoint, and got stuck here, and actually went below the midpoint, but eventually came up. In each of these examples, the market always goes up to test the highs, at least test the highs, if not go through them. So the reason why I'm suggesting that you look at this scenario, this opportunity, is because I believe the same thing here is going to occur. Now, in order to time this correctly, going long, buying the market only if it's above 27.84 on every opportunity that the market either pulls back, or as a day trader using the Atlas line or the trade scalper or any method that you yourself are using, buy the market as long as it's above 27.78, like we are right now. Let me just like this, like that. So if the market's above 27.80, 27.78, right, just about this midpoint here, it doesn't have to be exact, but it should be above 27.80, around this number here. If you have a long on a scalping trade, if you have a long on the Atlas line, if you have a long on the at the open, if you have a long trade on any method that you're taking, take the long opportunity, look at the average true range for a target. Again, have a stop, obviously, in case the market doesn't work out in your favor at that point. But your chances dramatically increase if you're taking long trades or long opportunities above this value here, significantly. Now, if the market starts to drop, which it could, right? We can go below the 27.80 midpoint here. If that happens, it's not saying you can't go long, but I think the short trades are going to be more in your favor. So now you're not just using a signal. You're not just using one idea to buy or to sell. You're grouping an idea to buy based off of this principle, along with scalping or price action or Atlas line or blueprint or roadmap or whatever methods you guys may be trading, especially the traders that work with me, or you're selling based off of this if it's below here. So I believe that before the end of the year, before December 31st, 2020, the market will reach this or come very close to it. And so I think there's a lot of great buying opportunities as long as it stays above 2,800, 27.78. Anyone have any questions for me here? Very simple. We're filtering out trades based off of this model. All right, very good. Let me switch now back to the 1-minute chart. Okay. I'm also going to add the Atlas line here so we can see the signals on the Atlas line as well. Part 2 of the webinar will cover the signals as they occurred live, the entries, the stops, the profit targets, the trade management. If you want to learn more about trading, visit DayTradeToWin.com, subscribe to the DayTradeToWin YouTube channel, the next mentorship class where we cover all of these methods with lifetime licenses for the software begins May 18th, 2020. Hope to see you there.